So moving forward, all of the accumulators we're going to talk about function virtually the same way. And the difference between how these operate and the producer flex floor is we're going to have one price that we accumulate at. So that accumulation level will be known on day one. And that is the price that we will accumulate throughout the life of that contract, either till expiration or until we're knocked out. Double ups will also occur at that accumulation level. Now, I remind you that the accumulation level is going to be at a premium to where the market is currently trading on day one. Speaking specifically for the weekly double up accumulator, how that works is we enroll bushels and price those out evenly throughout the accumulation period, just like before. But the market will trade from day one and moving on. And if the market does trade above that accumulation level, then you would double the amount of sales that you would make on that particular week. Now, why does this fit well in a range-bound market? Well, because we are getting that premium price. So we have a market that is relatively steady, relatively flat. Usually when this occurs, that means that we have an abundance of that commodity out there. And we also typically have carry in the market when that particular situation occurs. So this use of this accumulator is going to give us the ability to go out there and sell that carry with a little bit more premium applied. So we'll be getting a price that is superior to that flat price in terms of selling that market carry and in terms of the additional premium that we collect through the use of this structured product. So with this accumulator on accumulation day, which we typically establish as a Friday of the week, now if you don't like that, we can make the accumulation day whatever you choose it to be. But typically the standard is we accumulate on Fridays throughout the accumulation period. And it's simple. What happens is we will, you have your set bushels that you will sell every week. When that accumulation day, when the market settles on that accumulation day, we're going to look and see what the price is. If the market happens to be trading higher than our accumulation level, then the double up is triggered and you will sell twice as many bushels as the structure had intended to. So any accumulator that has the ability to double up has that risk of committing more bushels than we intended to, which does a couple things that could hurt us, right? First of all, it limits our ability to market grain in other ways with alternative contracts. And in the worst case scenario, we could get into a situation where we have actually committed to selling more bushels than we intend to produce. So knockout risk is something that needs to be looked at very carefully. As I mentioned earlier, if we get knocked out, it's going to be in a lower price environment than we were in when we started the contract. And we have those bushels that we thought we had sold in this accumulator that are now open and need to be marketed in an alternative fashion. So how the knockout level works is if that particular futures, whatever futures we're benchmarking against, trades at or below that knockout level at any time. So now accumulation level, that double up is only going to occur on the day that it accumulates, or Fridays. Knockout level could occur on a Monday or Tuesday. Anytime the market hits that level, then all sales that we have made remain in our account. So they're good, but nothing will happen moving forward. That accumulator ceases to exist. So a farmer that might choose to use this would be somebody that, for instance, is at or near their cost of production in terms of market price today, and really could use some help in getting that premium that's associated with these accumulator contracts. So we still have to be mindful of that double up risk and make sure that we're not overcommitting when using this contract, but it does help us to get closer to profitable levels if the market is low and doesn't appear to have any desire to improve anytime soon. So, for example, let's take our $4 corn. That's an easy round number to use. Futures, December new crop futures are trading at $4, and we have corn growing out there, a good crop of corn, and maybe we're behind on making sales. So we need to get in there and get busy in a market that's not offering us real great profitability levels. So it's hard to tell. So these accumulators are based off of options, and option premium is constantly changing. One of the big triggers for option premium is volatility in the market, right? So if the market is not extremely volatile at the moment, the premium might not be as much as it would be if we were in a volatile market. Regardless, we are going to collect some premium and add some additional profit to that particular cash sale. So an average would be maybe if it's May and we have $4 corn, maybe by December, if we do a new crop accumulator, we could see an accumulation level of around $4.20. So now instead of making sales versus a $4 futures, we are making sales versus $4.20 futures.